Hi everyone. Thanks for taking out the time to attend the webinar on a weekend. So the idea behind this webinar was to have a discussion on the new asset that we are bringing on the platform on coming Monday. So it's a gold loans backed covered bond issued by NBFC called as Dhanvarsha Finance. So we will jump straight into the presentation, and after the presentation, we will take various questions which many of you have asked during the registration. Right. So, most of you would be knowing, at Wint we bring assets which are secured. So the covered bonds should be backed by gold loans, vehicle loans, property loans, and so on. These assets should give a fixed return, which means the coupon or interest rate should be prefixed, and the underlying should be bankruptcy remote. So by bankruptcy remote, we don't mean that the assets cannot go bankrupt or cannot default. Rather, what we mean is the underlying pool of assets is bankruptcy remote with respect to the issuer. That tomorrow, if NBFC, who has issued the bond, were to default and go bankrupt, this pool of gold loans or vehicle loans or property loans is available exclusively for the covered bond investors. This pool will not become part of the bankruptcy proceedings of the NBFC. And this is a key difference between a covered bond and a regular secured bond. In a regular secured bond, even those bonds are backed by a pool of loans. But when the NBFC defaults, those loans, they become part of NBFC's bankruptcy proceeding. In a covered bond, these money coming for these pool of loans is available only for the covered bond investors, and this does not become part of NBFC's bankruptcy proceedings. And this is how it's a diagrammatic representation, how a covered bond is structured and how this bankruptcy remoteness is achieved legally. So if you look at the diagram, we have a NBFC, which issues the NCDs. Investors subscribe to these NCDs. In parallel, a SPV, a special purpose vehicle, is created. The underlying pool of assets backing the covered bonds are sold or transferred to the SPV. And SPV in turn guarantees the NCDs. The purpose of doing this transfer is to make the pool of loans, to ring fence the pool of loans with respect to NBFC, since the ownership has been transferred to a third party. So that tomorrow, even if NBFC were to default, the SPV guarantee will be invoked and money coming from this pool of assets will go to the covered bond investors. The asset that we are bringing on the platform, it's a covered MLD. Now, there is a difference between a regular covered bond and a covered MLD. In a regular covered bond, the interest is paid on a regular basis, and taxation is applicable as per investors' marginal rate of tax. Which means if investor is in the 30% tax bracket, the taxation on the interest which investor is getting will also be taxed at 30%. In case of MLD, the taxation is more efficient because in MLDs, the interest payout is linked to a equity underlying index. For example, in our live transaction, we have a scenario that as on maturity, if the Sensex value is more than 10,000, the investors will get a 11% rate of return. If Sensex value is less than 10,000, the investors will only get the principal back and there won't be any interest payoff. Now, because the interest payout is linked to an equity index, the investors can also claim LTCG benefit, which means if they hold onto their investment for more than a year, the taxation rate will be close to 10% only. Vis-a-vis a regular bond, wherein the taxation rate can be 10%, 20%, 30%, as per investors' slab rate. So that's why MLDs are much more tax efficient compared to regular covered bonds. So the NBFC which is issuing a Wint Gold June transaction is Dhanvarsha Finvest. It's a listed entity listed on BSE and NSE. It is backed by Aviator Emerging Market Fund, which recently infused close to 50 crores in Dhanvarsha. The net worth or the equity base of the NBFC is 160 crores after the recent equity infusion. The book size or portfolio is just above 100 crores. And it's present in, it's spread across gold loans, business loans, property loans, and so on. Dhanvarsha already has more than 10 existing lenders, including HDFC, CSB, Bank of India, SBI, NABARD, Union Bank, Northern Arc, Mass Financial, and so on. The collection efficiency of the NBFC has been strong. The gross NPAs were below 3% as on March, and net NPAs were less than 1%. One of the key credit comforts for investors investing in the transaction is that debt to equity ratio of Dhanvarsha is pretty small, is pretty low. If you look at the NBFC universe out there, most of the NBFCs tend to have a debt to equity ratio of around 4 to 5x. The regulations allow NBFCs to go as high as 6 times debt to equity, but most of the NBFCs tend to operate in the range of 4 to 5x. Now, comparing that to Dhanvarsha, because of the recent equity infusion, the leverage is not even 1x. So that gives a lot of credit comfort for the lenders. The returns on the transaction are 11% XIRR. The minimum ticket size is 10,000 rupees and the maximum ticket size is 10 lakh rupees. The bond is backed by gold loans, a pool of gold loans. The value of these gold loans is 1.25x times bond amount. So our live transaction is worth 15 crores. The gold loans backing this bond are roughly worth 19 crores. Now, each gold loan at max can have a loan to value ratio of 75%, which means if the gold value is 100 rupee, the maximum loan which Dhanvarsha would have given can be 75 rupees. So if our outstanding loans are worth 1.25x, the value of the physical gold backing the transaction will be almost 1.7x, because 1.25x is the principal amount of the loans. Now, gold loans have LTV less than 75%. So the value of the gold will be 1.25 divided by 75%. So the underlying pool of gold loans, it constitutes more than 1,500 loans. So it's a fairly granular pool of loans. The average ticket size per loan is roughly 1.2 lakhs. The maximum LTV is 75%. Now, obviously, all the loans may not have the same LTV. So the average LTV of these 1,500 odd loans is close to 72%. Alongside this pool of gold loans, Dhanvarsha has also placed a FD, which is equal to 7% or close to a crore. This FD has been placed with the State Bank of India and is lien marked to the trustee. So tomorrow, if Dhanvarsha defaults and even pool collections are not adequate to repay the investors, the trustee will dip into the FD and this FD will also be utilized to repay money to the investors. Coming to the risks for the investors in the transaction, we have bucketed the risks into three categories. First is the liquidity risk. Now, like I mentioned, these are fairly illiquid instruments, even though they are listed on BSE. So when you are investing, invest with the mindset to hold till maturity. Because in case you want to redeem before expected maturity, there may not be a willing buyer. You can reach out to us, and we in turn can reach out to various investors on our platform. And if we are able to find a willing buyer, we will facilitate the matchmaking. But having said that, there is no guarantee that a willing buyer will be available at all points of time. So invest only that much capital which you can hold till maturity. And maturity of the bond in this transaction is 15 months, provided Dhanvarsha doesn't default or go bankrupt. In the scenario that Dhanvarsha is not able to make the repayments, the money coming from the underlying pool of gold loans will be used to repay the investors, which can take incremental 6 to 9 months. The second risk is credit risk. So the risk for the investor will be tomorrow if Dhanvarsha were to default, and there are massive defaults in the underlying pool of gold loans, and let's say even the value of gold suddenly falls down. So in that scenario, even repayments from the pool may not be completely adequate to fully repay the investors. However, to mitigate this risk, we have taken a cover which is 1.25x times the bond amount. So within the structure, there is already a cushion of 25% built to accommodate any defaults which can happen in the underlying pool. The third risk is the fraud risk. What if the data that NBFC is sharing with us about the underlying customers and the gold collateral is fake? The borrowers may not exist on the ground. So to mitigate this, we have done a sample audit of the underlying borrowers. The sample size was around 15 to 20%, wherein we have done telecalling for the borrowers to verify that those individuals, the details of whom was shared by the NBFC with us, actually exist and have actually taken loan from Dhanvarsha Finvest. So yeah, that's the broad background about the live transaction. We will now jump to the queries. We'll take the queries which were first submitted during the webinar registration link, and thereafter we can take any pending queries in the chat section. Yeah, Jinkar.
Great. Okay, so we'll start with the risk-related queries. What will happen to my investment amount if gold price is very much lower at the time of maturity? And also every investment intervals. Okay. So the thing is that whenever the loan is given, the LTV is below 75%. Okay. Let us say the gold value, market value today is 1 lakh. So the borrower gets 75,000 loans. NBFC has a right to liquidate gold even before the maturity date if the gold prices start falling down. So what NBFC generally do when LTV hits, let us say 90%, so that gold prices has come down from, let us say, 1 lakh to now 85,000. So at that time they call the borrower, say please pay some fraud to keep the LTV below 75%, or bring in additional gold, or we'll go for a liquidation, right? So therefore, even like if there is a sudden drop of, let's say, 50%, then yes, there will be some losses. Therefore, we have extra 25% as a buffer. But that is very like plausible, but very low probability scenario. In that case, also, therefore, NBFC has a liability to pay to the investor, even if there are losses in the portfolio. Other than that, if gold prices don't crash suddenly overnight, the NBFC doesn't lose money on the portfolio, and investors also don't lose it, right? So even if the NBFC doesn't have to wait for maturity, that's the most important thing. The NBFC doesn't have to wait till maturity date to liquidate gold. If the gold prices are falling, NBFC has every right to liquidate that gold even before the maturity date. So, right. So the next question is, uh, what is safety, liquidity, modus operandi of repayment on maturity? Okay. So safety, we please look at the risk involved. So it's not just safety. There is liquidity risk, credit risk. Safety is mainly around credit risk. Do go through the risk documents. So there is credit risk. It is mitigated. How it is mitigated? By taking 1.25x number of loans. So for 15 crore, we have loans worth 19 crores. All these loans are gold loans with 75% LTV, right? So that's how we mitigate credit risk. Again, I want to iterate. In the last webinar also we spoke about this. This is not the risk profile of this product, and FD is different. This is riskier than FDs. FDs are low risk. This is high risk. So please mind that. Please know this fact. Please don't get misinterpretation. Don't hear to someone else who is outside Wint Wealth, right? These instruments are high risk. So there are risk mitigations, but that doesn't make the risk zero. There are risk involved. The instrument is high risk. I'm again iterating for everybody's sake, right? Because we don't want this to be misinterpreted in any way. Right? So then I'll take the next question. How will you ensure that assets which are gone bad during the tenure of the bond are replaced with reliable assets perpetually? Yes. So on monthly basis, then if any asset has gone beyond 60 days, right? Anshul, 60 days, right?
It's 90 days.
Okay. If any asset goes beyond 90 days, so if the borrower has not paid for the 90 days, then NBFC has to replace that loan with a healthy loan, right? And we do that review on monthly basis, and we also send out monthly investor report citing the same, mentioning all the details, right? So even if something goes wrong, 1 or 2%, those loans will be replaced by the NBFC. Suggest that you post all the webinar on your website or through YouTube channel. Yes, the last webinar we have already put on YouTube channel. This webinar will also be put on the YouTube channel, and so we are also making sure that this link is embedded in the asset detail page. May not be not immediately, but in near future we will do that, so that anytime people want to listen to the asset webinar, they should be. And for every forthcoming asset that we'll be getting on the platform, we will be doing such seminar where we'll talk about the asset in detail, talk about the risk involved, and any other questions related to that, right? So the last seminar is already on the YouTube, and this seminar will be also on the YouTube. How risk is managed if the underlying asset value decreases? So this is the same question we tackled earlier. This is around gold prices fluctuation, how that is maintained, buffer is there, and the NBFC can liquidate before the maturity date. So these are risk related questions mainly. Now we have some product structure, taxation related questions. Anshul will answer that. Anshul, over to you.
Sure. So first query is, can we sell the MLD before maturity? So like I mentioned, these are illiquid products. So invest with the mindset of holding till maturity. In case if you want to redeem the investment before maturity, you can contact us. We will reach out to various investors on our platform. Normally what happens is for each asset, we have a long wait list also. These are investors who wanted to invest but could not because the asset got sold out. So whenever an investor wants to redeem before maturity, we reach out to the investors who had entered their details in the wait list. And we also reach out to other investors on our platform. So in case if there is an investor who is willing to purchase this asset, then yes, that matchmaking can be done. But like I said, there is no guarantee that at all points of time, such a willing buyer will be available. How the value of security is monitored till maturity of the bonds. So every month, NBFC has to ensure that at least 1.25 times the bond amount worth of gold loans are there. Now, we know the bond is bullet in repayment, which means principal will be amortized at the end. but the underlying loans might be paying on a monthly basis. So whatever rundown has happened in the underlying pool, entity will replace that with new loans. So on a monthly basis, NBFC is obligated to ensure that asset cover of 1.25x is maintained at all points of time. Can I provide Form 15 so that no tax gets deducted? If yes, then how will that be done via a portal or over email? So as per the regulations, if the bond is listed, there is no TDS deduction. So whatever payments are done to the investors, trustee doesn't deduct any TDS since all these are listed bonds. So there is no tax deduction happening while making the payout. So I don't think submission of Form 15, etc. will be required. Next question is with respect to minimum lock-in, which I think we have already covered. Will the amount be credited to my NRE account fully or after deducting TDS? I think the person who has asked the question is a NRI, since the investor is referring to NRE account. To clarify, NRIs, as per existing regulations, cannot invest in bonds which are issued in India. So even this asset, NRIs are not eligible to invest. If they have a HUF which is based out of India, via that such an investment can be done. But NRIs directly, either via NRE or NRO account, cannot invest in these bonds. How do you finalize the rating agencies, and what is the frequency of rating updates? So the rating of our assets is done by same agency who has rated the NBFC on a standalone basis. For example, Dhanvarsha has an outstanding rating from Care Ratings. So even our transaction, our live asset, has been rated by Care Ratings. Rating agencies monitor the performance of the entity and transactions on an ongoing basis, but the formal surveillance is normally done once a year. What is the total portfolio of gold loans of Dhanvarsha? What's the expected return from the asset? The return in this live transaction is 11% XIRR. The total gold loan EM of Dhanvarsha is close to 25 crores. How about introducing more assets with a monthly payment option rather than paying at maturity? So yeah, we do have some transactions in the pipeline wherein interest payment will be monthly. So most likely in July, at least one asset will be monthly paying in nature. Please explain what is meant by bankruptcy remote with an example. Does that mean whatever asset is kept with Wint Wealth as collateral, that's not liquidatable as part of bankruptcy proceedings? Only Wint Wealth has complete ownership. So it's a very good question. I'll break this into 2-3 parts. When we say the structure is bankruptcy protected or bankruptcy remote, it doesn't mean asset cannot become bankrupt or asset cannot default. What it means is whatever pool of gold loans which has been allocated for the transaction by NBFC, tomorrow if NBFC were to go bankrupt, that pool of loans will be outside the bankruptcy proceeding of the NBFC. Now, that's the advantage of covered bond over the regular secured bond. For example, if we look at Diwan Housing as an example, Diwan Housing had issued a number of regular secured bonds in which it had given a pool of housing loans as security. Now, even though that pool is performing well, Diwan Housings and borrowers are repaying on time. and that money is coming to Diwan Housing. That money is not going to Diwan Housing's secured bond investors. This is because in a secured bond, the underlying pool which is given as security becomes part of the bankruptcy proceeding. It is not bankruptcy remote. While in a covered bond, a special purpose vehicle is set up to which the underlying pool of loans is sold. By this legal mechanism, this underlying pool becomes bankruptcy remote and essentially ring fenced from NBFC's bankruptcy. Which means tomorrow, if NBFC were to go bankrupt, this pool of loan will be available exclusively for these covered bond investors. No other lender of NBFC can make a claim to this pool of assets. So that's the meaning of bankruptcy remote. And I just want to clarify one more thing. Wint Wealth doesn't have the underlying collateral. The ownership of the collateral is with the special purpose vehicle which has been created, which is monitored by the trustee. Wint Wealth doesn't have any ownership in that SPV. That is completely owned, managed by a trustee who will take care of the repayments in the scenario NBFC were to default. The money coming from that underlying pool will be credited to investors by the trustee. The money will not flow via Wint Wealth, nor Wint Wealth has any ownership of the underlying collateral. Why is the issue size so small? So for now, we have been till now we have been bringing out assets where the issue size was between 10 to 30 crores. But going forward, yes, we do plan to bring in assets where the issue size might be up to 50 crores. So gradually, as the investors on our platform increase, the asset size should also increase over time. What if NBFC is unable to issue new loans? In such a case, the cover pool will be affected. So I think the question is, we say that NBFC is obligated to maintain a security cover of 1.25x throughout the life of the transaction. But what if NBFC is not able to add additional loans to compensate for any rundown which has happened? So it's a trigger event as part of the transaction structure. If in any month NBFC is not able to add loans to do the replenishment, then if it happens for 2 consecutive months, the money coming from the underlying pool will start going to the investors. Essentially, the transaction will start winding down. Whatever money is coming from that 1.25x times pool will start going to debentures as repayments for the investment. Could you share some differential pointers as a financial instrument when it comes to investing in gold bonds and in gold-backed covered bonds? So I think the risk return profile in a SGB, sovereign gold bond, and a Wint gold covered bond is completely different. Those are almost zero credit risk instruments because they are issued by Government of India. These are high risk instruments because here the issuer is a NBFC. Though there is a pool of assets, but the risk profile is nowhere close. Those are zero credit risk bonds issued by Government of India. These are regular bonds, covered bonds issued by private NBFCs. So that is, I think there should not be any confusion. The risk profile is nowhere close in these two options. Even the returns, there the returns are linked to how much increase in gold price will be there, and there is some markup over that. In this transaction, the returns are fixed. For example, here we have 11% returns. So the risk return profile for both the instruments are completely different. Is there any specific reason for not having a monthly payout structure like Wint Wheels? So like I covered in my MLD slide, in a market-linked debenture, the taxation for the investors is superior compared to normal monthly repaying covered bonds. Now, So that's the advantage, that taxation is superior. The disadvantage is the payout to the investors can be only made on maturity, depending on the Sensex value. So uh, at Wint, we plan to bring both kinds of products. Few will be monthly repaying, and few will be bullet MLDs. Why to choose Wint Wealth over a mutual fund, which is normally diversified across various bonds? Yeah, so how we look at our products is it's not a replacement for FD or debt mutual funds. It's a diversifier to your overall portfolio. In a debt mutual fund, the diversification is more because the number of bonds in which a mutual fund might have invested is large. So even to our investors, we suggest whatever allocation you are doing towards Went Wealth products, try to diversify across at least 5 different assets, so that tomorrow if there were to be a credit event in one of the investments, it should not be your entire investment is at risk. So let's say you plan to invest 100 rupees in Went Wealth products, try to diversify across at least 5, if not more, assets, so that the same diversification benefit which are available for mutual funds, etc., can be made available even in these investments. Another point, another difference which I'll want to highlight here is in Wint Wealth, investing in Wint Wealth bonds vis-a-vis investing in debt mutual funds. It's something similar to investing in directly in stocks or doing the same via equity mutual funds. So it's a choice you need to make. If you think the incremental returns which you're getting by directly investing in these covered bonds uh, seems appealing, I think you should directly invest in the bonds. If you think you don't have the time to understand in detail each Wint Wealth assets, and you would rather invest in a mutual fund who in turn can invest in 10 bonds, even that is perfectly fine. So what we suggest is Wint Wealth is a diversifier. Uh, both are not mutually exclusive things. An investor can very much invest in debt funds, and if investor properly understands the risks and return in these covered bonds, a small allocation can be made here also. Please give your credit rating so that investors can properly assess and invest their money. So ratings for all the NBFCs that we bring on the platform, and ratings for all the bonds are there on the platform. Even the rating rationals are uploaded on the platform. Wint Wealth per se is not rated because we are just a platform. We are a company who is enabling investors to in turn invest in rated fixed income products. Why risk appetite is restricted only to secured loans? Is there any business strategy behind this, or only to give good return compared to inflation? I think the question is tomorrow can we bring covered bonds which are backed by unsecured loans where the underlying hard collateral may not be there? Uh, so far, at least in near term, we don't see that happening. For now, we want to stick to asset classes where the underlying are secured loans backed by gold, vehicle, property, or similar like hard collateral. For at least in the short term, we don't plan to bring any unsecured covered bonds. Why only NBFCs and why not other corporates? So yes, non-NBFC covered bonds is something definitely in the agenda, and we will be bringing assets on the platform where the issuer may not be a NBFC. It can be a regular corporate who in turn is issuing a bond which is backed by some hard collateral asset. How do you hedge the gold security against the market price? What happens if gold prices crash suddenly? I think this we have already covered. What's the amount of loan book value against the gold assets? So like I said, it's a 15 crore bond backed by almost 19 crore worth of gold loans. Each loan at max can have a 75% LTV, which means the value of physical gold is roughly 1.7 times. Is Wint planning to launch any new asset which has better than FD returns, but duration is short or ultra short? So in future, we will be bringing assets where tenor is, let's say, somewhere between 3 to 12 months. So these assets are definitely in the pipeline. What's your outlook on gold prices by end of 21 or say March 22? So it's difficult to predict. Gold prices are driven by multiple parameters, a lot of which are international. I think it's like there are too many variables to predict in which direction gold prices will move. In case of MLD, I read somewhere that units need to be sold in secondary market before maturity in order to avail LTCG benefit. Will Wint Wealth buy these units from investors before maturity to meet this requirement? Yes, so there are two views in the market with respect to MLD taxation. One view is even if you hold till maturity, you will get the LTCG benefit, which means taxation will be 10%. Second view is you need to redeem before maturity to get the benefit. So if there is any investor who wants to take the second view and wants to redeem, let's say, 10 months before maturity date, we can facilitate that. Is it possible to take insurance against these assets so that there is no risk to the investors? A blanket insurance, insurance is something which may not be possible, though there are players in the market who can give a kind of a guarantee. But if there is a player like who is giving 100% guarantee, the net returns to the investors will be substantially lower. So that's the trade-off which one needs to make. Invest in a product which is, let's say, giving 11% returns with the proper mitigations. Or let's say if we were to do 100% guaranteed bond, which has been guaranteed by a good rated guarantor, the returns there might be maybe 6 to 8%. So the counter view will be then why to invest in such a product? Why not just park with in the FD of some bank or invest in debt mutual funds? So the short answer is if one were to take 100% guarantee on the product, the net returns will almost be same as FD or debt mutual funds. What is the legal maturity of the MLD? So it's important to understand for these covered bonds, there are two maturity dates. One is the date on which NBFC is supposed to make the payment. Second is the date which will be more relevant if NBFC has defaulted or not made the payment. So for example, in this transaction, Dhanvarsha is expected to make the payment by 15 months, by the end of 15 months. If Dhanvarsha goes bankrupt, is not able to make the payment, doesn't pay, then money coming from the underlying pool of assets, which is second recourse available to the investors, will be used to redeem the bonds. Now, the underlying gold loans, they have a tenor between 6 to 12 months. So in that scenario, the relevant maturity date will be 2 years because it might take incremental 6 to 9 months for all the money to come from the underlying security pool. So I would say the legal maturity will be 24 months in the scenario that NBFC has defaulted. If NBFC is performing well, the maturity will be 15 months. Is the collateral for the covered bond physical gold or loans which have physical gold as collateral? It's an important point to note. So it's not like for a 15 crore covered bond, there is 18 crore worth of physical gold. Rather, how the structure is for a 15 crore covered bond, there are 18 to 19 crore worth of gold loans, which in turn are backed by gold. which means if any of the customer in the gold loan pool defaults, then the gold which he has kept as security, as collateral, will be liquidated, and that money will go to the redemption of bonds. So there are two layers. One is 19 crore worth of gold loans, which in turn are backed by gold, physical hard collateral gold. So yeah, how is covered bond different from secured entity? So like I covered earlier also, the main uh, differentiating factor here is the bankruptcy remoteness of the underlying pool of assets. In a secured bond, the second layer of comfort, which is the pool of assets, that also becomes a part of bankruptcy proceeding of the NBFC. In a covered bond, that pool of loans is available exclusively to the covered bond investor. Money coming from that pool will be used to repay the covered bond investors. When gold loan companies like Muthoot can borrow at 8 to 9% for gold loans, or sorry, the question is when gold loan companies like Muthoot charge only 8 to 9% for gold loans, how can you give us 11% interest in these covered bonds? So normally these single digit gold loan rates, they are offered only by the banks. Even larger NBFCs, they charge in the range of 15 to 22% XARR rates. At, time, at times, these lower rates might be marketed by a few NBFCs, but those are mostly for marketing purpose. Bulk of the deployment that they would be doing will again be in the range of 15 to 22%, 23%, and so on. The actual single digit rates for gold loans are given only by banks, but the turnaround time of giving out the loan tends to be longer. And if a customer is taking a gold loan, these loans are normally taken for emergency purposes, and ease of getting a loan is valued by the customer much more compared to the interest rate of the loan. So customers are more than willing to pay higher interest rate, provided the turnaround time is lower. And a lot of these NBFCs, they're able to quickly turn around the loan, but they charge a premium for providing this service compared to banks. How do we know the same gold loans are not repledged with a different institution by the NBFC? So it's a valid point. So to mitigate this, we do a sample audit on a recurring frequency, wherein we check the systems of the NBFC, whether proper tagging of loans has been done. And it should not be that the same loan has been tagged to two different transactions or two different lenders. The returns, if calculated, comes to be 9.15% per annum, while you have published 11%. So the returns are 11% only, 11% XARR. One can easily run a XARR formula on Excel. This is the cash flows which are coming and the dates. So returns are definitely 11% XARR. If there is a default by the NBFC, what is the time duration within which the investor will get the investment? Like I said, in the scenario that NBFC has defaulted, it might take 6 to 9 months or more for investors to recover their money from the underlying pool. Is the interest also given in such a scenario? Yes. If there is money coming from the underlying pool, interest will be given. And in fact, in such a scenario, a penal interest of 2% will be given over and above what has been promised. So the returns to investors in such a scenario will increase from 11% to 13%. Does Wint Wealth keep track of the NBFC financials until the maturity of the bonds? Yes, we do have a dedicated risk team, which on a quarterly basis does a credit evaluation of all the NBFCs. Why do you get a higher rates from NBFCs when they can source funds at a much lower rate from other sources? So if we look at the NBFC universe, there are different NBFCs who borrow at different rates. For example, someone like HDFC or Bajaj Finance, they can borrow from at rates which are, let's say, 6 to 8%, while a lot of NBFCs are there in the market where the borrowing rates are actually between 9 to 12%. These would be NBFCs with AUM between 500 to 10,000 crore. And these are the NBFCs that we normally work with. So these are not very small NBFCs. They have a decent AUM, have good systems, processes, operations in place, are more often than not backed by a good private equity player, have lower leverage, and are also able to offer decent rates to the lenders, to the investors. And these are NBFCs mostly in triple B, triple B plus, or A rating categories. So these NBFCs, for these NBFCs, the borrowing rates are between 8 to 12%, which is what they offer to our investors also. Criteria to choose the best loans as collateral. When these loans mature, do you receive replacement loans? And is the same process of cherry picking good loans carried on for replenishing pool also? Yes, so when we select any pool of loans for our transaction, we ensure that proper filters are applied. These filters can be, let's say, in terms of maximum LTV that we can choose. In terms of single client concentration, it should not be the pool is chunky. It should be granular enough. It should be properly diversified across geography. So for each entity, each asset class, we have our in-house filters using which we cherry pick the pools for our transactions. And the same process, yes, is followed for replenishment also. Next question is, why can't Dhanvarsha directly raise money from the market rather than going via Wint Wealth? Yes, they can definitely issue a bond and invite investors to directly invest in the transaction. But they may not have the investor base to reach out to. At Wint Wealth, because of our proper branding, risk practices, etc., we now have enough investors on the platform, and NBFCs have surety that if they issue a bond, firstly, Wint Wealth will buy it, and Wint Wealth in turn has a surety that our investors will be able to buy these bond units from Wint Wealth. So if a NBFC already has their own investor base of individual investors, they can definitely issue bonds directly also. In fact, we do see NBFCs like Shriram, Chola, etc. They keep on reaching out directly to the retail investors on their own also. Next question is on the margin that Wint Wealth is charging. So it varies between 1 to 2% per annum, transaction to transaction. So yeah. Yeah, Jinkit, over to you.
Yeah, one more. Yes. So now we will take the business related questions. So one general request is that we and our education team is always available on WhatsApp during the daytime. So most of these questions have been asked by people here. Now in the Q&A we have about still 150 unanswered questions, 100 questions answered. So really happy to see that people are asking questions so that we can educate, we can answer those. But many questions I see are not one-line answers that we cannot give you in writing immediately. It's not that we don't want to answer. If your question is not answered here, feel free to ping us on our WhatsApp number that is there on the website homepage. And we will, if required, we will get on a call. If required, our team also gets on Zoom calls, explain the products, risk in detail, and answer your all the questions. Right. So there is no hurry. You can ping us anytime. We will get in touch with you. We'll explain we'll answer it to the T. And from the previous webinar and people who have ever interacted with me, Anshul, or any co-founder or anyone at Wint Wealth, right? Our always focus has been transparency and education, right? So always expect honest answer from us. so many of the questions that are in this Q&A on the webinar may go unanswered because of lack of time, but we are always available on our WhatsApp number. So you can ping anytime. There is no bot, like people immediately come and answer that, right? So we are there to answer, and if required, many people get on a call and understand product better. You should understand that. But just a small request that feel free, if the question is not answered in Q&A here, because for the lack of time, we may not be able to answer everything, then it will be like, please ping us on our WhatsApp number. Right? So with that, I'll take the business related questions. Is Wint employee, are Wint employee investing on any Wint product offerings? Yes, on all employees invest in all product offerings. It is kind of compulsory, right? At promoter, every deal I have myself invested, Anshul has invested, and even interns at Wint are required to invest in every product that we bring on, right? So, and as a Wint, as a company, we hold 2% in every asset, right, on the platform, 2% till maturity. So anything happens, that we also have skin in the game. When Wint will float an IPO, or how do I become private shareholder as a retail investor? Really humbled by this question. Really, this really actually gives us a lot of energy, but that's not on cards. The answer is mainly regulatory challenges. Okay, so even in these bonds, we are solving a lot of regulatory challenges. I would personally prefer to have all the investors be equity investors of Wint, because of regulatory challenges, that seems like very difficult thing to do. But really thankful for this question. Can we hold longer than maturity date? Can I just keep my money in there until I want, like an FD or savings account, and then pull out whenever I want later? No, that's not possible. On the maturity, the bond matures, and you get the amount in your bank account that is connected with the TMAP. You have to reinvest. Whenever an asset will mature, we generally will have another asset coming in for those set of investors specifically, so that they can reinvest money easily, right? But they will still have to do it manually. It cannot be there perpetually. Do you see yourself adding an option to sell units of your fund to interested buyer midterm? Clarification one, we are not a fund. We are a platform through which you can invest in these individual bonds. At the end of the day, you are going to hold these bonds. Yes, you can sell them prematurely before the maturity date, provided there is a buyer. Provided there is a buyer. I've said this again and again. That liquidity is not guaranteed by the platform. It is completely dependent on the market. If there is a buyer, we will definitely facilitate this transaction. After the asset gets over, generally we open up the waiting list. Many of you must have registered in the waiting list of the previous assets. So whenever somebody wants to sell, we get in touch with people on the waiting list, and people invest. The last 3 assets we have done, in all assets we have 1,000+ people on the waiting list, right? But that does not guarantee that we will be able to prematurely sell. So we generally recommend people to only invest that much amount that they can hold till maturity, right? With a mindset of holding till maturity. Why the return of newly launched asset is decreasing in order? The first asset yields maximum return, since then they are decreasing pattern. So this asset gives 11. So it will always fluctuate between 9 to 11. That depends on the rating of the NBFC balance, multitude of factors. There is rating, which asset class they cater to, what is their leverage, what is their lender profile like, what is their growth look like. Because if NBFC is growing very fast, they want more debt, so they might be ready to pay a little higher interest because they want access immediately capital. Yeah, and so variety of factor, about 10-15 major factor that decides at what rate NBFC actually borrows the money. So, and we will, like, the first asset was 10, then 10, first asset was 11, then 10.25, then the next asset gave 9.5%, then this one is giving 11, the next one is giving 9.25. So it will always vary in the range of 9 to 11%. What is your motive behind starting Wint12? Are there any competitors for Wint12 in the market? What is your business model? So yes. So competitor, we are the currently only one democratizing this covered bond asset class. We plan to democratize more and more asset classes. So there is no competitor as such. Second is, what is your business model? We make about 1.5% on the money invested per year, right? So if you have invested, let us say 10,000 rupees approx, then approx, I mean, from deal to deal, it might vary from 1 to 2% or here and there, but approx we make 1.5%. That is, if you have invested 10,000 rupees, every year we'll make 150 rupees on that investment, as long as the money is invested. My age is 25. What percentage of my portfolio can I allocate to this instrument? Should be in the range of 5-10%, should not be more than 10%. But there is a big caveat here. If your age is 25, first, like what we call it is famously called the framework. So that means you should have term insurance, you should have health insurance, you should have emergency fund for 6 to 12 months. Only after that you should invest in other asset classes. So because you are the person who asked the question is 25-year-old, I want to basically suggest that please cover the basics first, like the term insurance, health insurance, and the emergency fund, and then look at all the portfolio allocation. In fact, we are doing something we are planning something around asset allocation, about in general asset allocation, and how can you do better asset allocation, some basics of asset allocation. So stay tuned for that as well. For a moderate risk taking person, how much exposure one should have in Wint12 in their portfolio? So please consult a registered investment advisor for that. In general, I can talk about, in general, what we say is this should not be more than 5-10%, conservatively on 5% of your total portfolio, right? But I cannot comment on this specific, saying, hey, this is like, if this is your risk profile. And often risk profile is a very nuanced understanding. So, like even if I say I'm a high risk investor or I'm a moderate risk investor, risks are very interpreted very differently. So I don't want to comment on that and misanswer that. New investor to Wint want to understand their business model before allocating some funds. So idea is simple. We are democratizing asset classes. So these are covered bonds where the earlier minimum investment used to be 25 lakhs, 50 lakh. We are democratizing that building. And Wint12 is a platform for investing in those asset classes at lower ticket size of 10,000. We make about 1.5% per year basis. Yes, so this has been a common concern that contract note is not sent, and it is not just in this question and answer. Offline also, people have been suggesting this, and we are working on this, and it will be that feature will be integrated soon. So it's on the cards. Okay. So the question was about the contract note is required for each investment made. That will be made available soon, right, on the platform. How to upload money to Wint12.com? When to upload money to Wint12.com? How will the money remitted back to my account? So you don't have to upload. There is no wallet system. You just invest through either UPI, net banking, or debit card through payment gateway on the platform. And if you want to sell, there is a buyer. Then you can sell and get that money. Or at the maturity, that when the maturity happens, the money will be transferred. Money will be transferred to your bank account that is connected with your Demat account. That is connected with your Demat account. Even the monthly interest option, whenever there is, the monthly interest is always credited to bank account that is connected with your Demat account. Okay, so Indrajit just informed me, we don't have debit card enabled as of now. It will be enabled in future. Is it good option for first time investors in their 20s? Can you elaborate on the risk pertaining to this particular segment? Can't answer this question, buddy, because this is very pointed question. I don't know what is your finance goals are, what is your background like, how much are you earning. So so please consult someone, preferably a registered investment advisor, for these questions. Is Demat account mandatory for investing in Wint products? Yes. Can I get loan on covered bond? Can I use this as collateral for shares trading? No, you cannot get loan on covered bond, and you cannot use this as a collateral for shares trading. So that is decided by the regulator, and it is not currently permitted. So in any broker, no broker in the industry can offer that at the moment. Right? So that answers the question. Uh, so there are still 172 unanswered questions here. I'm going to go through one by them. If I can answer shortly, I'm going to answer. We have a deadline of 6:30 for this. If not, I'm going to just request you to ping our WhatsApp number, because most of these questions will require some detailed explanation. They just cannot be written here. Right? The covered bond tenure is more than you're offering. For instance, gold Jun21 is for 2 years, but your offering is 15 months only. Do you hold the bond further after debiting from our Demat accounts? If so, why not provide this option to your investors? Anshul, do you want to answer this question? This is a repetitive question.
Yeah, so like I explained, the legal tenor of covered bond is 24 months, because that scenario will occur if NBFC has gone bankrupt or defaulted. Now, NBFC is supposed to make the payment at the end of 15 months. But if they're not able to make the payment, it might take 6 to 9 months for money from underlying gold loans to fully redeem the debentures. I'm saying 6 to 9 months because the underlying gold loans, they have a tenor approximately in that range. So it might take 6 to 9 months from 15 months to fully recover the money. Hence, the legal tenor of bond is mentioned as 24 months, but NBFC is supposed to make the payment at the end of 15 months. So it's a 15-month bond. In the scenario NBFC has gone bankrupt, it might the tenor might get extended by 6 to 9 months.
Thank you. So interest rate is 12.25 for the bond in the information memorandum, but 11% on the website. So that is our profit margin in this. We have separately charged to the NBFC as well. The question also says that in Wint bricks, the 9.5% was both in the IM document on your website. I'm pretty sure you had profit margin in Wint bricks too. Yes, we had a profit margin. We charged directly to the NBFC. Here in this asset, we have charged some amount to the NBFC and some through the interest rate difference in the bond. Investing through Wint is safe. When can I expect mobile app? So investing through Wint is safe, but assets, they involve certain risk. They are high risk asset. They are not low risk asset. The risk is not zero. That is not a FD like product. I want to repeat this again and again for the sake of clarity. So do check the risk profile before investing. When can we expect mobile app? It is in the pipeline. We will come out with shortly. Delay of payment from client after maturity. Didn't understand the question fully. Please ping on WhatsApp. In case the fraud risk. Anshul, there are a lot of questions. I'm just summarizing the questions. A lot of questions around why this bond is related to Sensex and why not EA. Could you answer that again? So why have we actually connected it with Sensex, and why did we decide on, let us say, 10,000 and why not 5,000 or 20,000? Could you answer this question and explain the logic again till I skim through other questions?
Sure. So, like I said, this is a MLD, market linked debenture. We have structured this as a MLD so that end taxation for the investors can be efficient. Now, MLD by design, the underlying interest payoff has to be linked to some index. It can be Sensex, it can be Nifty, it can be even government bond rates. Now, Sensex and Nifty are easily understandable. That's why we have chosen one of these two index, because you as an investor can estimate what is the probability of Sensex going down from 50,000 to 10,000 within, let's say, 15 odd months. We could have chosen GSEC rates as well, but GSEC rates people are not very familiar with the GSEC rates. So it's difficult to estimate a probability of GSEC rates going from 6% to, let's say, 2%. So because of familiarity, mostly, we have taken Sensex as the underlying.
Okay. Anshul, could you also explain about, like, a lot of questions are hinting toward this. Could you also explain how much these NBFC, what is the unit economics for the NBFC? Why is NBFC paying 11% to the investor? They are paying about 1.5%, 2% to us. How much money they are making? How much do they actually charge borrowers? And why these borrowers are, like, obviously they are making profit, then the interest rate must be high. So why are these borrowers even borrowing from NBFCs? And are these risky borrowers? Why are they paying so much high interest? Are the NPA probability high? What happens if they don't pay? Could you just take that question?
Right. So the end rate that NBFCs normally charge for gold loans, like entities like Dhanvarsha, etc., would be somewhere around 20% or more. Now the costing for NBFC, including Wint wealth margin, etc., would come out to be somewhere between 12.5 to 13%. Now, so we are left with 7 to 8% margins for the NBFC. Out of this, since NBFC would be setting up branches, having employees, offices, etc., there would be a certain operational expense also. This operational expense in turn can be varies entity to entity. At scale can be around 4 to 5%. The balance of around 4% is the profit after OPEX, after finance cost, but before credit cost. Now, in a gold loan, the credit cost normally is zero, because even if the end borrower were to default, the NBFC has gold as security. So NBFC will just liquidate the gold and close the loan. So even if we assume a 0.5% credit cost, NBFCs are still left with a profit of around, let's say, 2 to 3%. So that's their profit before tax. That's the profit before tax for the NBFC. In terms of why customers are paying such a high amount, see, a customer who is taking a gold loan is not that much worried about interest rate that he or she is paying. Rather, they want operational ease in terms of getting the gold loan. Because we also need to remember the gold loan tenor is only 6 months. So the amount of incremental interest, 6 to 9 months. So the amount of incremental interest that customer would be paying will not be that material enough. It's not like home loans, wherein a customer is paying high rates for a very long time period of 15 to 20 years. It's a 6 to 9 month kind of loan, wherein customer can pay a higher interest rate, but they need a loan quickly. The turnaround time has to be very fast. It also happens because gold loans are normally taken during emergencies. So someone's like a family member might be ill, there might be some emergency expense, etc. So normally the requirement is they will just walk into the branch and expect to get money for the gold as collateral within 30 to 60 minutes. And that's the speed that a lot of these NBFCs are able to provide. And hence they are able to charge this premium also, compared to banks who can give out gold loans at, let's say, 10% rates also. But their turnaround time may not be that quick, and there may not be certainty also that the customer will eventually get the loan or not. But in case of NBFCs, customers are more or less certain if the gold is genuine, NBFC would disburse their gold loan.
Sure. Anshul, the next set of questions are around whether the SPV, whether the SPV holds the physical gold collateral, where is the physical gold kept, what if the NBFC runs away with that gold collateral, who is this SPV, who are these trustees, what is their credibility, and mainly around this, like if NBFC goes bankrupt, what is happening? like gold, where is the gold and what happens to that?
Right. So the legal ownership of the gold loan is transferred to the SPV. SPV is a special purpose vehicle set up only for this transaction. The legal status of the SPV can be a will be a trust. The SPV is managed by someone called as trustee. Now these trustees are companies who have got their license to operate as trustee from SEBI. In market, there are three to four such commonly known trustees. We work with only those commonly known trustees. So one of them is appointed as a trustee for our SPVs. The ownership of gold loans and the right to liquidate gold in case of default is with the SPV. However, the physical possession of gold is still with the NBFC. This is done due to operational reason because borrower has taken loan from the NBFC. So to make the repayment and take back the loan, borrower will visit the same branch from where the initial loan was disbursed. So physical gold still lies in NBFC's branches, but legal right to liquidate the gold in case of default is with the SPV. In the scenario that NBFC has gone bankrupt, SPV has all the legal rights to liquidate a loan, take possession of the gold, etc. A major risk in gold loans is something called as fraud risk. What if there is a small NBFC? NBFC has gone bankrupt and promoter runs away with all the gold, which is kept in NBFC's branches. So that's also a key reason why we don't work with the smaller NBFCs, which are promoter run. So if you look at all the gold loan assets that we have brought, a key criteria for us has been it should not be a pure promoter run company. There should be an external institutional investor also who is running the show and has invested equity in the company. So that's how we mitigate this promoter risk or fraud risk.
Great, thank you. Anshul, could you also talk about the bond rating, the NBFC rating, and what is the difference and how is it derived and contours of that?
Right. So the Dhanvarsha,
Before that, really sorry to interrupt here. Could you talk about who is the trustee in this and what are their credentials? Are they SEBI empaneled trustee? And what is the SPV name if you can reveal? Like,
right. So SPV has been set up in the form of trust. It's called Wint Gold, I think 02. It's managed by Catalyst Trusteeship Limited. They are the leading trustee in India, having a AUM of more than 8.5 lakh crore. They obviously have registration with SEBI also. They are SEBI empaneled trustee. So yeah, that's on the trustee part. Coming to the ratings, Dhanvarsha is rated triple B by K Ratings. The rating of the transaction is A, again by K Ratings. Uh, the rating uplift has predominantly happened because of the bankruptcy remoteness of the underlying pool. Tomorrow, if Dhanvarsha were to go bankrupt, the pool will step in and the pool will be used to repay the investors. Hence, the rating of the transaction has also been uplifted.
yes. A lot of questions are around what is the role of Wint, what is our business model. So our role is pretty simple. We actually, a lot of people have asked like, what is your due diligence? How do you select NBFCs to work with, right? So we have a basic clear criteria for selecting NBFCs. I have myself written a blog, a 3-part blog on how do we choose to work with NBFC. It is there in the resources section of the website. So we choose which NBFC to work with. What kind of loans would you go in the bond? What should be the tenure of the bond? What should be the interest rate of that is charged to the NBFC? Then once the deal is finalized, we help the NBFC execute the deal. That means we coordinate with trustees, we coordinate with rating agencies, we coordinate the listing approval, listing requirements so that the bond is listed. and then then make it like complete the NCD transaction, then take it to retail, facilitate end-to-end retail investors buying, and if required, if there is a buyer, then selling also, right? And then educate investors, any queries, any questions related to it, solve it. So all these end-to-end operational legwork, so that involves 2-3 things main. One is regulation. So we help NBFC raise money through proper regulatory framework without violating any law. Second is educate investors. What we are doing currently, or what our education team keeps on doing every day, is educating investors. Second is this distribution platform where you can seamlessly now go buy and buy, or in future also sell very easily on the platform. So we take care of all those aspects. And for that, and business model wise, we make about 1.5% on the money invested per year. So if you invest, let us say 10,000 for 2 years, then we'll make 150 rupees every year. So we'll make 300 rupees. Yes. We have 7 more minutes, so we'll try to finish any other question. Is Demat account necessary? Can HUF invest? Yes, Demat account is necessary. HUF can invest. HUF has to open a Demat account. How are covered bonds different from secured bonds? Are covered bonds safer than secured bonds? Why is a return offer on covered bonds higher? Anil, can you take that question? Still, I'll skim through other questions.
Yeah, so main difference between a covered bond and secured bond is even secured bond has loans as collateral. A key difference is those underlying loans in case of secured bond, they become part of bankruptcy proceeding if NBFC were to go bankrupt. So the example that I gave in case of DHFL, now DHFL's end borrowers are paying on time, but that money is not flowing to the secured bond investors because DHFL is in bankruptcy. So all the loans which are given as security, they have also become part of bankruptcy proceeding. In case of covered bond, since there is a SPV to which loans have been sold, so even if issuer of the bond were to go into bankruptcy, the underlying collateral pool of gold loans, vehicle loans, property loans is still bankruptcy remote. It will not become a part of NBFC's bankruptcy proceedings. An example of this is DHFL's securitization transactions. Even in securitization, we have these SPVs. So investors who had invested in DHFL's securitization in transactions, they are receiving their money on time as the underlying home loans are paying, as the money is coming from the underlying home loans. While secured bond investors, they are not getting even a single rupee. All the money that is coming from the underlying home loans is stuck in DHFL's bankruptcy proceedings. So that's the key difference between a covered bond and a regular secured bond. And that's why investing in a covered bond is less risky compared to investing in a regular secured bond.
Yes. Anshul, one question is around how is this portfolio contours like? Is there a average vintage, say XCMI have to be paid? And what if somebody prepays it? When new loans are added to it, what is the criteria? So can you talk a bit more on that?
Right. So each asset class and each NBFC, so for each of the asset, we have a eligibility criteria, which defines what kind of loans can be included in our transaction. For example, in case of Dhanvarsha, we have two key criteria. One is the LTV of each and every loan in the transaction cannot be more than 75%, which means if the gold value was 100 rupee, the loan given should have been 75 rupee or lower, so that tomorrow, even if gold prices were to crash, there is adequate buffer available to us. Second criteria we have kept is we have tried to make the pool fairly granular. which means no single client can have a concentration more than 1% in our overall transaction. So if you look at the pool which is there are roughly 1,500 customers, and it's a fairly granular and diversified pool, which means even if few customers were to default, it's not like all our money will be stuck there. So similarly, each asset class, each NBFC will have its own criteria.
Sure. How about refer and earn scheme? Yes, we are launching referrals. So it will be launched on the website. So that should be done in a couple of weeks. So you can check that. Another question is any benefits to regular investors versus high value investors? So we treat everyone equally. So even if somebody is investing 10,000 rupees or 10 lakh rupees, they will get exact same commercial, exact same interest. So we'll never have this differential pricing. Yes. What is, Anshul, can you talk about NPA performance of Dhanvarsha through COVID? What is the current NPA rate look like, and what are the other products that they are doing, and how is the NBFC performance like?
Right. So Dhanvarsha as an entity is in various asset classes. They have a gold loan business, which is the segment they really want to focus on. Second is their secured lab book. Third is their unsecured book, which is predominantly business loans and personal loans. So the performance of gold book has been pristine, I would say. They haven't. There isn't even a single loan which was in a 90 plus bucket. So there hasn't been any NPA in a gold portfolio. In their lab book, there was some vintage par, which was coming from loans originated before 2018. The recently originated loans have been performing well. So their NPA numbers as on March were below 3%, and net NPA was below 1%. Yeah.
Whether the investor can be in joint names. So you hold the security in your demat. So whatever applies for your demat will be, so all you have to do if you want to open joint, like invest jointly, open a joint account, open a demat account that is connected with that joint bank account, and then invest here. Similarly, anything that is on your demat level parameters, like if you're nominee on demat, same applies for here also. If there is no nominee, there is no nominee here. So whatever applies to your demat, you're essentially buying the security in your demat, right? So whatever applies to demat applies to this as well. How many employees are there in Wint? About 30 now, growing fast. What are cost per asset incurred by Wint for bringing each asset to investors? It is very hard to estimate cost per se because there is a lot of due diligence that goes on regular basis. Then there is education cost, salary cost. So it is very difficult to project it on a monthly basis, like on an asset basis, because the same team works on different assets, right? How fast does the investment window normally run out? Is it fastest finger first, or does everyone get a chance? So depends. The last asset was subscribed in just 4 days. So it is first come first serve basis. If the asset runs out, then you can't invest. Then you have to enroll in the wait list. Whenever one of these investors want to sell for some reason, you can buy that. Yes, we are past time. Yes, so we are wrapping up this session because we have other commitment. But that doesn't mean that we have answered most of the questions. But any question that is unanswered, my apologies for that. But do ping us on WhatsApp. People have asked us what is our WhatsApp number. It's there on the website. It's there on the website, so you can directly ping, and it will directly make you visit WhatsApp with a sentence saying, "I have a query and please help me." So thank you everyone for joining us. As discussed, we will be also conducting now webinar for every asset that is coming, and we'll be conducting a different webinar just focusing on risk. What are the risks involved? How is the asset structured? And just this understanding this asset class. So stay tuned for it. Thank you everyone for joining us. Thank you. Have a very pleasant weekend. Thank you.
Thank you.